Good afternoon. Of course, investors looking ahead to the U.S. jobs report data that is due later today. Another key indicator just before the Fed meets for its next interest rate decision later this month. Looking at Asian performance, a bit of a mixed picture on that front. We saw commodities taking a dive, and this is on the back of news and fears around another China lockdown. When we look at what's happening from a European side of things, it's the European energy situation that is another major fault line for markets. Russia set to resume the supply of gas through its key pipeline. And again, we're still dealing with the fears that perhaps we might even have another halt going into the winter. When we bring things locally for a bit, the corporate calendar bare today as we look at the currency markets, the rand around 17.32, Brent trading at around $94, and our local indices, all share index up about 0.5%, led there by the resources and followed quite closely by the financials and industrials. To give us a sense of the week that was, and also touch on what many analysts have described as a horrid month of August, we are joined by Lukman Otunuga from FXTM. Lukman, thank you so much for your time. Quite an interesting space to be in, especially when we look at global market developments. How are you reading sentiment right now?
Thank you for having me here. Wishing you a great Friday. Yeah, it's been a mixed week for markets with sentiment mixed. Other than some headlines that have caught our attention, like global bonds coming into their first bear market in a generation. It's that familiar calm before the storm ahead of the NFP, where equities, currencies, stocks are all on standby ahead of the next fresh directional catalyst, which is the US jobs report. It's fair to say that whatever the outcome of this afternoon is likely to set the tone for September.
So, I mean, some of the analysts we've spoken to this week, are ready to look into September because August was so horrible. I mean, how are you looking at the month of August from a review perspective when you look at the cross-asset picture?
From a bird's eye view, it's not really been a pretty month. Stock markets are down. The dollar, of course, remains mighty. Surprisingly, the euro is also appreciated, but other G10 currencies like the pound, yen have all fallen under the mercy of appreciating dollar. Interestingly, emerging market currencies were also under the crosshairs and, bowed to a stronger dollar. I think in August that these movements were based around inflation expectations, recession fears, and the fact that central banks continue to raise interest rates in an aggressive fashion in order to tame soaring inflation. The risk-off mood and rising treasury yields have boosted the dollar, and I think this continues to pressure commodities and emerging markets. I wouldn't be surprised if this sentiment rolls over into the new month.
On that note, then, I mean, we're going into, themes such as peak inflation, peak hawkishness, and depending on who you speak to, they'll say to you that September is generally a horrid month for the Dow and the S&P historically. So is it safe to say that I should wake you up when September ends?
I think it's safe to say so. I think this looks like a recipe for disaster. Indeed, the first month of autumn has historically been seen as the worst month of the year. Investors are getting back from the summer holiday lull. They may be readjusting their portfolios. And some psychology can play as well. The psychology of the fact that September is seen as a notoriously poor month for global stocks may fuel the sell-off. But, global equity bears remain heavily reinforced by the fact that we have higher interest rates, we have an uncertain macroeconomic background, soaring inflation, and just that risk-off sentiment. So when we add these two together, I wouldn't be surprised if September is another poor month for global markets.
So, I mean, we were talking a little bit earlier about, the non-farm payrolls data that we are expecting. What does data mean for this market? Because, the past week we've had good data, which is bad news for the market. So I'm not sure whether good news is bad news and bad news is good news.
And that's true. So for somebody who's new to the market, this may look like, a puzzle that doesn't make sense. Really, when economic data is positive, it should feed into sentiment, it should feed into that risk on mood and elevate equity markets. But we're in a very delicate situation right here where the more good news that we are received to that markets feed investors, the more it fuels expectations of the central banks aggressively raising interest rates. Now, these high interest rates are fueling fears over tipping the respective economies into a recession. It's a juxtaposition, if I may name it. I think this is going to be the theme moving forward, especially this afternoon. If we've got more good news that the NFP does meet expectations, even though on paper, this is really good news, to investors. This is bad news, especially those who are heavily invested in the equity markets and gold.
I spoke about Europe's energy crisis. What's next for Europe? I mean, can it get any worse from here?
We've got geopolitical tensions, surging inflation, recession fears, a vulnerable currency, and sheer uncertainty. When you add the expanding negative shock, the conquest from Russia reducing its gas supplies, it's just, things are really looking really terrible for the Eurozone economy. And looking at monetary policy, I really want to be colourful here, Anastasia. Imagine central banks in a 100-metre race. We've got the Federal Reserve, Bank of Canada, and other super hawkish banks near the finish line. The European Central Bank, Bank of Japan are still way behind, stumbling behind. And you've got the fact that in Europe, inflation is already hitting 9.1%. The ECB may be forced to step up into higher gear to raise interest rates to stop it from negatively impacting the economy. And, this is why next week is very big for the European Central Bank. Regardless, though, even if they do move ahead with hiking rates, there's so many negative factors hitting the European economy, with markets expecting, a recession to be around the corner due to the soaring energy prices and geopolitical risks really hitting sentiment.
Lukman, let's leave it there. Thank you so much for your time. And as Lukman alluded to in his responses, we are waiting for that non-farm payrolls data due later today, giving us an indication in terms of where we could be going when it comes to Fed announcements. Although market is already pricing in 75 basis points, the same kind of assumption that we are also looking at when it comes to the ECB.